Well, after 5 up days in a row, the S&P 500 finally had a down day. In fact, we were down over 1% when it was all said and done, and we did close near the lows of the session here today. NASDAQ once again outperformed as it was down less than the other indices. The Dow suffered as a result of Boeing and some other travel stocks struggling on a bit more of a basis there. We did see that gold hit multi-year highs. We saw Tesla skyrocketing. Some very interesting stats coming out of that move here recently, where they've basically tacked on the market cap of the big three in Detroit, Chrysler, GM, and Ford, just in 1 week's time. So who knows, maybe we'll wake up one day and hear that Tesla's going to buy one of those companies out. So we've been watching a lot of those momentum stocks and how they've impacted the markets. We'll talk about all that, see what that means for our posture. We'll then get into a trade application example of a stock that broke out today from the healthcare space, which has started to pick up steam here recently. So with that, let's go ahead and get started. Welcome to the Market Outlook video presented by MarketScholars.com. I'm your host, Brandon Van Zee. It's July 7th, 2020. If you're new, first of all, welcome aboard. Remember to go over to YouTube, click subscribe. While you're there, check out our description area and sign up for our email distribution list. That way you can be notified whenever David and I post these videos, and you can also get a heads up as to what stocks are giving you overbought and oversold cluster signals in the S&P 500. With energy stocks down tremendously today, I imagine we'll probably have a lot of energy stocks that'll show up in the cluster list here today. In addition to that, we're heavy users of Twitter. Make sure you're following me if you're not already. My handle is @BrandonVanZ. We do appreciate those of you that click like and retweet for these market outlook related tweets that we generally pin to the top of our timeline over on Twitter. And then lastly, we have a presence on Facebook. Feel free to check us out at that group listed in the logo there in front of you. All right, let's go ahead and jump into our charts here. As you can see, I've got the S&P 500 pulled up here on chart 6D for those of you that are following along at home as premium students. I like to start with this particular chart whenever we have at least a 1% move in either direction. Today, of course, was one of those 1% down moves today, 1.08% to be exact. You can kind of see how that looks in that middle portion of that graph right there. We've got this red bar going from the zero line here in black down here to this 1% down move in the blue right there. So while today's sell-off was maybe considered a little bit above average, remember that the last 2 times we've actually had sell-off days, they've been worse. Right over here on the 26th of June, it was a 2% down day, and the time before that was the 24th of June, which was also just more than a 2% down day. So anyway, the last 3 days that we've had any selling, they've been a little bit above average there, and that's not entirely unheard of. We have kind of reached a new level of volatility, it seems, here over the last several months of 2020. You can see that volatility, speaking of which, it did creep a little bit higher today, and we reside right around 30 on the VIX here currently. And of course, that is still considered historically high for normal trading conditions as we try to figure out what this coronavirus news means for the economy, which in turn what that means for the stock market itself. Let's go ahead and get on over here now to our chart 4B and kind of get a sense of a bird's eye view of the 4 major U.S. equity indices here. And as I mentioned in the intro, the NASDAQ once again was the leader. In fact, the NASDAQ on an intraday basis hit an all-time high here today. The NASDAQ composite got up to 10,518 before turning tail and then closing a bit lower here today by about 0.86%. But that was the best performing index of these 4 that we watch here in front of us. And so no surprise, our posture remains bullish on the NASDAQ. You can also see we have a bullish posture on the S&P 500. Remember, when you're looking at these green background colors on this particular chart, 4B, it reminds you that we have bullish intermediate postures. Remember, there's several different postures that can be developed from the market forecast technical indicator that you can find on the Thinkorswim platform. The green line is the one that we focus on most often in this particular presentation. In the class I'll be teaching tomorrow morning for my Plus and Premium members, we'll focus a bit more on the near-term line as swing traders. But generally speaking, this particular presentation is more for the intermediate style trader here on YouTube. The one thing I did want to point out about both the S&P 500 and the NASDAQ is that technically we do have what's known as bullish intermediate confirmation signals that have popped up here today as well. And that occurs when we've got the green line, or that intermediate line, uptrending or simply in the upper reversal zone. So in the case of SPX, it's uptrending between 20 and 80. At this point, it's at 67 and rising. And in the case of the NASDAQ composite, we're just above 80. So it doesn't really matter at that point whether we're rising or falling. In this case, we do still happen to be rising at about 91. Anyway, both of those would be considered strongly bullish postures at this moment in time. That combined with red line, in this case the momentum line in the low reversal zone, creates what's known as a bullish intermediate confirmation signal. And those signals are meant to kind of assist the trader with the whole idea of buying the dip. What you're trying to do is buy dips within an uptrend in this particular case. Whether we're still in an uptrend or not is driven by whether the green line is still bullish or not. And as I just mentioned a moment ago, we still have strongly bullish postures on both of those charts. The red line is more of a sensitive day-to-day mover. You'll see here that the red line can go from the upper reversal zone and down and up and down and up much more quickly than the blue and the green lines do. So when we have sell-off days, there's a better chance than not that the red line will go into the lower reversal zone. Now, one thing that you might have heard us talk about in the past is this idea of ideal bullish intermediate confirmation signals or less ideal. These two right here would be considered less ideal for a couple of reasons. First of all, when the blue line is above 50, it gives us the sense that we haven't had enough of a near-term pullback in order to get too excited about the whole idea of buying the dips. It gives us the impression that there may be another bit of an exhale just around the corner, maybe tomorrow, maybe the day after that. So you can see right here the blue line is still above 50 on the S&P 500. It's actually at 65 right now, so we'd like to see that number somewhere between 50 and 20 on the days that we get the bullish intermediate confirmation signals. For the NASDAQ composite, it's the same situation. In that case, it's at 69. Again, it's not between 20 and 50. And then another thing that makes it a less ideal signal this time around is the fact that the red line is in what we would consider to be extreme territory. In other words, you can see that the number on the red line, the momentum line, is 2 for the S&P 500, and it's 1 for the NASDAQ composite. Anything below 5 we consider to be an extreme move, and it has the potential to eventually start changing the chart. Now, we don't know that to be a fact. We just want to be a little bit mindful of that possibility. What I will say is that in the last 3 months, whenever we've had those extreme moves lower, even on days when we've had those bullish intermediate confirmation signals, it has not changed the trend up until this point. So it's something to park in the back of your mind. It's not necessarily something that has to scare you out of a trade. It is just something that you'll keep in your mind when you're position sizing, perhaps doing smaller positions than you normally would. So we do have bullish intermediate confirmation signals on the S&P 500 and the NASDAQ composite at this moment in time, but both of those would be considered less ideal signals. In terms of the other two charts, you can see that the Dow Jones Industrial Average currently has what we would consider to be a weekly bearish posture. You see that light color pink background of the chart right now, and that signifies when we have the green line that is somewhere between 80 and 20 and falling, so we know right there that it's going to be a bearish posture. Where the green line is depends upon where the color coding will change. So for instance, you can see that for one day back here, it was just a couple of days ago, we had this darker shade of pink. And the reason for that is we had a bearish posture that day, and the green line slipped just a little bit below 50 on that particular candle there. I know it's hard to see with the naked eye, but remember, you can read these numbers kind of in the background right where I'm circling right there. If I go back and point at that candle and you scan your eye back there, you should see that it says 48.26 right now. So since that number was below 50 and it was falling on that day from the prior day, we went to a strongly bearish posture with that darker shade of pink. Well, since we had a bounce day immediately after that, it kind of provided a little bit of levity to the line as well. That green line then went from being below the 50th percentile to being back up above it. And so even though we did fall fairly substantially today, another 1.5% on the Dow Jones, it wasn't enough to push us back below 50 because yesterday's move to the upside was so big. So, a lot of conflicting signals, as it should be, pretty obvious here, where we've the bulls and the bears have been fighting back and forth with each other, particularly on the Dow. It's been less so the case with the NASDAQ. The NASDAQ has been a stellar performer through it all, but the Dow has had bouts of selling here and there mixed in with the bouts of buying. Right now, I would say the path of least resistance continues to be to the upside because the moving average continues to drift higher, but the selling days are more pronounced with the Dow Jones. And all you have to do really is compare where is the candle right now in relation to its multi-month high. Well, in the case of the Dow, you can see the multi-month high was way up here at 27,500. We're now down here below 26,000 at this moment in time. Now compare that same mentality to what you're looking at on the NASDAQ composite. Well, you compare to where we're at right now to its multi-month high. That just happened this morning, right? It's not back here. With the Dow, it put in its high back in the first week of June. First week of June for the NASDAQ was back here. We're still trading above those levels. So if anything else at all, even if you don't know how to necessarily read the market forecast technical indicator, if you can just look at where the placement of the candles are in relation to prior major highs and lows, you'll get a general sense of who the leaders and the laggards of this market are right now. So you can see down below here that the Russell 2000 is somewhat similar to the Dow Jones, where you have that yellow moving average, so price is below a falling moving average right now. You have a pink background color, light pink, so telling us we have a weekly bearish posture. Now, in the case of the Russell 2000, that's been more consistent for the last couple of months, whereas we've seen more back and forth posture changes with the Dow. Nonetheless, you can see that it shares some common elements with the Dow in that where it's trading right now is not anywhere close to where it was trading at its peak that first week of June. So again, the two laggards of this market, without a doubt, Dow Jones Industrial Average, the mega caps, and the Russell 2000, the small caps. So kind of your bookends there. The market cap driven areas that are driven by stocks like Apple and Microsoft, which would be a big portion of both the S&P 500 and the NASDAQ composite, are doing just fine because tech is red hot right now. And remember, Tesla itself is not even part of the S&P 500. I heard somebody on CNBC today mention that Tesla's market cap is now bigger than 97% of the stocks in the S&P 500, even though it itself is not part of the S&P 500, because there are some other constraints there in terms of several quarters of profitability and things like that. So that's another possible catalyst in the future if Tesla was ever allowed to be part of the S&P 500, but right now it's kind of on the outside looking in. Nonetheless, obviously, its stock has gone absolutely ballistic. For those of you that haven't been watching it, here's what that chart looks like. It's basically just gone straight up in the last, let's call it week. 6 trading days ago, it was below 1,000, and right now it's sitting right around 1,400. So it's gone up like 45% in a week, depending upon where you're measuring that from. And you can see here just in the last 3 months, it's up 169%. That is not a normal mega cap company, but we are in quite abnormal times. I think we can all agree upon that here at this moment in time. All right, let's go ahead and take a look here at our 3 green arrows setup now. And that'll be chart 4D for those of you following along at home. Now remember, on this particular chart setup, the background colors will tell us whether we have a 3 green arrow setup, a 3 red arrow setup, or neither. And as it stands right now, we have 2 of our charts with 3 green arrows. And those 2 charts are the 2 that I mentioned were leaders on the other chart as well. So the S&P 500, we've got that green background color there, and the NASDAQ composite down below. Those 2 both are what we would call 3 green arrow status right now, which means that they have bullish indicators on their 30-day moving average, bullish indicator on their MACD histogram telling us that momentum is strong, and then bullish indicator here on the stochastic as well telling us that prices are generally trading in the upper half of ranges out there and the bulls are in control of the chart. The other two charts over here, the Dow Jones and the Russell 2000, don't have 3 red arrows. They don't have 3 green arrows. They have a mix. And in the case of the Dow Jones, the red arrow is on the 30-day moving average as we close just barely below that here today. However, we still have green arrows here on the other two. In the case of the Russell 2000, we have a red arrow on the moving average and also a red arrow on the MACD histogram, but it retains its green arrow for the time being on the stochastic. So again, another sign that the leadership in this market belongs mostly to the NASDAQ composite, but then that flows through to the market cap weighted S&P 500 as a result of the S&P being dominated these days by mega cap tech, right? Your Apples, your Microsofts, even your Amazons, although technically they're not technology, but Amazon is also considered kind of a tech-oriented company that is a major portion of the NASDAQ composite. All right, let's go ahead and now take a look at some 12 grid analysis. And I'm going to pop on over here to, let's do the asset classes first. So this will be chart 5A. And as we pull this up, reminder that these 12 grids, when we're looking at these miniature charts here, the color, because it would just look too funky to have switching colors all over the place on these miniature charts, there's only going to be one color associated with each of these 12 charts, and that color is telling you what is the current posture according to the market forecast intermediate line. When you have pink charts, obviously, those are going to be bearish postures. When you have green charts, obviously, those will be bullish postures. So, the chart that continues to impress me the most is gold. And again, I apologize for sounding like a broken record as I've been talking about this for the last 3 or 4 months, but it continues to work. So why not keep talking about it? Keep pressing into it. In fact, right now we still have some bullish trades going in that particular area. I think the most recent one we did was the junior gold miners, and if I'm not mistaken, they had a pretty good day too. GDXJ is where we traded there, and yeah, you can see GDXJ, the junior gold miners, are up 62% in the last 3 months and hitting a new multi-month high here today. So whether you're looking at GLD, which tracks the price of gold itself, or some of those gold mining companies, it's from the lower left to the upper right, and they're making some money for you if you've been willing to take a roll of the dice in that particular area of the market. I know Newmont's been doing really well. Kirkland Gold's been doing well. Royal Gold, Nova Gold, Yamana Gold, Harmony Gold, Goldfields. There's a whole bunch of them. And the challenge is many of them are small cap in nature. And they really don't get a lot of institutional press because they are so small. For instance, Newmont Mining is the only gold mining company in the entire S&P 500. Barrick is also a very big gold mining company, but it's not technically based in the United States, so it's not in the S&P 500, but that's another decent one that you could probably take a look at. Its ticker symbol is GOLD, so just for gold itself. Anyway, gold keeps on working. Part of the reason behind that is the chart to the left of gold, which is the US dollar. US dollar, as you can see, has been weak. And I'm sure I didn't get a chance to listen to David's presentation last night, but I'm sure that he would have told you about the big move out of the emerging markets yesterday. You can see that move right up here on EEM. It was actually a back-to-back type of a move where you had this gap up right here, and then you had an even bigger gap up from last week to Monday, which was yesterday. Now, it did sell off a little bit today, but you can see it has been a heck of a run for those foreign stocks. Now, EEM is actually up 20% over the last 3 months, easily beating the S&P 500 and beating its developed foreign stock rivals as well. So remember, when you have a weak US dollar environment, which is what we find ourselves in right now, clearly pink background color there for the US dollar, red moving average. We've got some double top resistance right here as well. That's a good environment for things like gold, for things like oil, for other types of commodities. for multinational US-based companies and for pure foreign companies that might be out there, whether it's China or Russia or Brazil or what have you. So those are areas of interest that, if you're not finding a lot of success with your traditional US-based stocks, maybe foreign stocks, maybe commodities. Otherwise, in the United States, we do still have pockets of strength within technology stocks and a few healthcare stocks here and there. As far as some of the areas that are struggling a bit more, you can see that high yield bonds, preferred stocks, and the 10-year U.S. Treasury yield all have what's known as strongly bearish postures in addition to the U.S. dollar. Where we find ourselves right now on TNX, it was down again today, and so if you move that decimal point over to the left one, it basically reminds you that the 10-year interest rate right now in the United States is 0.65. So very, very low interest rates, and probably will remain low for quite some time as the Fed is doing everything in its power to kind of supercharge what it can do in the economy. All right, let's go ahead and take a look at our next 12 grid. In this case, it'll be chart 5C. These will be our sectors, and these are going to be the market cap weighted version. So this will give extra emphasis to your Apples and your Amazons and your Exxons and those types of companies. Well, today we had only a couple of sectors that finished positive. The main one was the staples. Some of you might have been following me on Twitter earlier today when I was tweeting about Walmart. There was some big news out of Walmart today. Where they're going to be competing apparently head-to-head with Amazon Prime and offering their own subscription service where basically you would pay $98 a year and get free delivery. And one of the things I was mentioning on Twitter is, they have a chance to compete with Amazon, which would not normally be an easy thing to say. And I think a lot of it will revolve around whether they can pull off free online grocery delivery on a same-day basis for that same subscription fee. And if they can, then they may have a chance at beating Amazon at their own game. Until then, you have to make the assumption there will be a lot of growing pains. And right now, Amazon's got things pretty much figured out, and so they'll still be the go-to. But I don't think I would outright dismiss the deep-pocketed Walmart right out of the gate when they have ambitious goals like this one. So anyway, Walmart was up a lot today, and as it is one of the largest companies from a market cap perspective within the consumer staples space, the consumer staples themselves were actually up nearly 1% today on a day when the stock market itself was down 1%. And you can see that nice bounce up and off of that moving average right there. In terms of downside performers, energy really struggled here today. You can see that energy from an ETF perspective with XLE actually put in what's known as an oversold cluster signal. Now, if you haven't been hearing us talk about those types of things lately, it's because there's a good reason for it. The stock market has been blistering hot, and when we have a blistering hot stock market, you rarely have extreme oversold conditions that would allow for a bullish cluster like that. And so this is actually the first bullish cluster on any of these charts we see in front of us in the last 3 months. That's what each one of these 12 charts is, a 3-month chart. So this is the only green dot you see on the entire board. So that's saying something. Of course, that was not the case had we pulled up 6-month charts, because there were plenty of them in the middle of March. But we've had a good run of things in this most recent 3-month period, and energy all of a sudden has kind of fallen by the wayside. So energy was down 3%, and financials also really struggled here today, down 2%. And look at how far and how fast both of those areas have fallen. So the financials really topped out back here first week of June, and energy topped out first week of June as well, and they both fallen considerably over that time period. So that will bring up a good segue as I pop on over here to the internet and show you my sector selector rankings. Now remember, I come out with these over the weekend, so this would not have any impact on what has happened so far on Monday and Tuesday this week. But even going into the weekend, you can see how financials fell off of the map, and you can see energy falling off of the map. And again, remember, this is as of last Friday. So I had no prior knowledge that, here on Tuesday, financials and energy were just going to completely fall apart. But, it just goes to show you that if you're using a lot of these resources, they can assist you with making, hopefully, better choices with the trades that you're making. And again, this is a tool that is available for those of you that are premium members of Market Scholars over on our Tools tab of our website. Now, the other thing I wanted to point out here is that we did have one major change into the top 3, and that is healthcare. Healthcare zoomed from number 6 slot last week all the way up to number 2 as of this most recent ranking of Friday evening. And so healthcare is all of a sudden starting to perk up again. Now, technology remains number 1, and it has been really for pretty much every week since the beginning of May, with the exception of just 1 week where it fell to the number 2 slot, just briefly at the end of May. But otherwise, you're looking at 9 out of the last 10 weeks, technology has been number 1. So all these things that David and I bring to you in these free YouTube videos as well should support that, because we've been mentioning the outperformance of those work from home stocks, and the outperformance of technology, and the outperformance of growth stocks, and all that kind of rolls itself perfectly into the technology sector itself. So anyway, key takeaways: energy, financials really falling out of bed. Healthcare really starting to make a move to the upside. Also, while I'm over here on the internet, I wanted to say thank you to all of you that help support these free YouTube videos. The best way that you can do that for David and I is click like for us on Twitter, and you can do that while you're watching it here right on our website through this little widget that you see here. Otherwise, you can just go over to Twitter itself, and it should be pinned to the top of our timeline. Anytime I get over 100, I'm satisfied, so we got to 101 last time around. If you want to see these videos done as often as possible, please continue to do that. I'll try to get these out a little bit earlier going forward, as well as I'm trying to get my personal life schedule adjusted a little bit more, as a few more things like daycares are starting to open up around here. So tonight's video should get to you a little bit earlier than they have been recently, and I'll try to keep that up as well. If you appreciate that, be sure to click like there for me. Also, remember that tomorrow I've got my factor-based swing trading class for those of you that are Plus and Premium members. Earlier today, I taught my dividend growth investing class, and the sector that was up the most today, the staples, happened to be our sector of focus in that particular class. So if you were interested in seeing which stock we ended up buying for our long-term portfolio, it was a dividend aristocrat from the consumer staples space. Feel free to watch that recording if you are a Plus or a Premium member. All right, let's go ahead and get back on over to our charts, our Thinkorswim charts. And I wanted to discuss our trade application now that we have a little bit of background knowledge about which sectors are working and which ones maybe not working quite as much. And for this, I'm going to pull up, let's just do chart 3A. And I'm going to pull up a healthcare company, since healthcare itself has been surging more recently. And I wanted to talk about a company that doesn't get a whole lot of press, although I've been seeing a few more people chatting about it here and there, and that company is ALNY. And let me explain kind of why this chart stood out to me. There was, another possibility that I had was Amgen. Amgen had a heck of a breakout here a couple of weeks ago, but they've started to roll over a little bit up here, so I didn't want to tempt fate there too much and get into it just as it was rolling over. I was hoping to find something with a bit more strength, and so that's where that ALNY was a very interesting situation. First of all, here's what the 3-month chart looks like, and you can see we had a very excellent day here today. We ended the day at 160. It was up nearly 5%. But if we were to go back and let's look at, let's say, a 5-year chart real briefly, notice that it was an important day here today as well, because we broke out above all of this prior resistance area. So this was not just a quick little 3-month breakout. We're talking about a stock that has been breaking out to multi-year highs here this week. I'm not sure what this looks like on an all-time chart. Yeah, this is an all-time high that we're dealing with here. When we go all the way back to 2004 using monthly candles here, you can see that this has been etching out with some pretty wide swings, I'll grant you that, but etching out some higher highs and higher lows along the way. So let's zoom back into the 3-month daily view here, and wanted to show you that at this point it was kind of interesting to me to watch this one play out. If I were to get my drawing tools out here, I'm going to kind of point something out to you. I don't know, something like that. So you can kind of see that we had this very serious resistance area that was in place from basically April 20th all the way until at least May 19th. And you had 1 or 2 days where the upper wicks were kind of going up and through there. But for the most part, that was a substantial resistance area that the bulls just simply could not get the bears to relent long enough. And the bears just kept on selling at those levels and pushing the bulls back lower. Well, eventually the stock started to trade below its moving average and almost gave us the impression that it was going to give up the ghost and start turning into an underperformer. You can see that it started trading a little bit below these dotted lines here on my chart, which represents the pathway of the S&P 500 at that time. So for a brief moment in time, it was actually underperforming the market itself. Then we had this really nice surge here in the middle of June where it went right back up, and on this candle, this was a very important candle here, and you can see that it happened on really big volume. Notice that that candle is all in green. It's got the little black arrow in there telling us that it was more than 1.5 times your normal volume candle, and we closed at the high of the session. You can see that clearly broke out through that prior resistance there. So we went up. We came back down for a couple of candles here, so it was called a breakout retest. We kind of spent a little bit of time right at that retest area, and then in the last 2 or 3 days, we started to make a move higher again. And in doing so, we went up and over that prior resistance point right there on the 26th. So today, you can see we had another above average sized volume candle. Now that one was not filled in all in green because we didn't close at the high of the session. We sold off a little bit there, but importantly, where we did close was still 5% up, and the closing price was obviously above all of these prior marks on the chart. So even though we didn't close at today's high, we did close well above any of the candles on the chart here in the last 3 months. So a very impressive day there. You can see, of course, the blue line is heading higher, telling us our near-term posture is bullish. You can also see that the intermediate or green line is at 80 and rising. So with today's big surge higher, that green line went back up into the upper reversal zone, telling us that the intermediate posture is also considered to be bullish at this moment in time. So what I thought we would do in this particular case is do a just a normal swing trade. I did check out the options, but this is not the most liquid security out there. So I just wasn't as comfortable with that idea in this particular case. One thing I do want to point out, it does have earnings coming up here on August 5th. So that gives us about a month here in this case to be in this trade. If we don't hit our price target or don't get stopped out by then probably the more prudent approach would be to pull the trade off before earnings to avoid having a major gap against your position there. So that gives us about a month to be in this particular swing trade. And the area that I want to focus on as far as our bogey, where we'd put our stop loss, is a couple of pennies below the low of this candle that I'm pointing at right here on June 29th. Now the low that day was 145.36. So we're going to put our stop loss in this case at 145.34, 2 pennies below that low. And so if I get my calculator out here, of course it's after hours here today, so I have no idea whether the stock market is going to open up, down, or sideways tomorrow. But we're going to make an assumption right now that we're going to get filled at 160. After all, that's where it closed here at the end of today's trading. So let's try to get filled at 160 tomorrow morning. And then I'm going to subtract out of that $145.34, which is where we would put our stop loss. That means we're taking about $14.66 of risk per share. And if we wanted to maintain a 1-for-1 reward risk ratio, then we'd want to add that $14.66 back to $160, or our entry price, which means our upside price target is at $174.66. Now in this case, since we're taking about $14 worth of per share risk, I'm not going to do 100 shares. Normally I just leave that at the default, but in this case I think I'll just do 50 shares. So that way our worst case scenario there would be a loss of about $700 in case it went against us. So in order to place that trade, I'm going to come over here to the chart. I'm going to right click on it. I'm going to go over here to buy custom with OCO bracket. Down below here, these are already locked together with that paperclip, so I can change this to 50 shares or whatever your position sizing is best for your own paper money account. So I'm going to hit enter. It changes the lines directly below it to -50 and -50 there, so all those match. On that top line there, I am going to try to get filled exactly at 160, our closing price here today. If it doesn't get filled there, so be it. There are plenty of other trades out there, plenty of fish in the sea. So we'll just leave that in there as a one-day situation. If it gets filled tomorrow at 160, great. If it doesn't, then we'll move on and try to find another trade another day. Now that next line directly below that, that'll be our upside price target. And so that would be the 174.66 that came up on our calculator there. We're going to change that from a day order to a good till cancel order, and then the line directly below that will also change to a good till cancel order. And then lastly, that final line there we need to change to our stop price, which will be 145.34, or 2 pennies less than that low price that we had about a week or so ago. All right, so let's go ahead, click confirm and send. And you can see one way to see if you have a one-for-one reward risk relationship is by looking at the base. Here it says base plus 1466, and then it says base minus 1466 on our sell orders right there. And the OCO stands for one cancels other. So that means that if this stock were to do what we want, which is to go up to 174.66 and sell our position out, the stop loss would automatically be canceled on the downside. On the other hand, if we fall flat on our face and this stock goes down and stops us out, then the upside price target would be canceled out. So it's a way for us to kind of not feel the need to have to be right on our computer 24/7 babysitting our position. So with that, let's go ahead and send it in, and we'll see if we can get filled first thing in the morning. All right, thank you for joining me here yet again. Remember, tomorrow I've got my factor-based swing trading class for those of you that are Plus and Premium members. Feel free to join me for that. And then David will be teaching his options inventory class a little bit later tomorrow afternoon. And then he'll be back with you for the Market Outlook video tomorrow night. So the next time I see you, best of success with your trades and your investments. Goodbye for now.